7,500 Bitcoin, at one point worth more than $600 million, conventional liabilities totaling only a few million, and based on the company's last disclosed share count adjusted for the reverse split, an implied basic equity value that recently fell into the single-digit millions. But current market data providers disagree sharply on GDC's share count and market capitalization, so even the exact size of the corpse is still awaiting confirmation. On paper, GD Culture Group should look like someone left a treasure chest unattended in the morgue lobby. But Wall Street did not send a locksmith. It sent a coroner. Because while investors were calculating Bitcoin per share, management was issuing shares by the hundreds of millions. After the at-the-market sales and the registered direct offering, the aggregate percentage ownership represented by the March 31st share base had been reduced by roughly 94%, assuming those shareholders did not purchase additional shares. And while two entities that had participated as sellers in the Palace transaction offered to take the company private, the company later performed a 1-for-250 reverse split and never produced a binding merger agreement. Somewhere inside this case is either one of the most extreme asset discounts on NASDAQ or a masterclass in how reported value can remain permanently separated from the common shareholder. Tonight, we open the file on GD Culture Group, ticker GDC, a company reporting 7,500 Bitcoin, almost no operating revenue, approximately 980 million pre-split shares issued after March 31st, and enough unanswered questions to fill every drawer in the market mortuary. Welcome back to Wick's Market Mortuary, serving body bag holders since 2026. This investigation is for informational and entertainment purposes only. It is not financial advice. Public filings, company statements, and third-party information can contain errors, omissions, or facts that later change. Always conduct your own investigation before buying, selling, or embalming a security. GD Culture Group is a Nevada holding company currently headquartered in Jersey City, New Jersey. Its recent public identity combines artificial intelligence, interactive entertainment, digital marketing, and cryptocurrency treasury management. That description already sounds like someone entered every popular investing keyword into a corporate name generator. But GDC did not begin as an artificial intelligence company. It did not begin as a Bitcoin company, and it definitely did not begin as an interactive fiction company. GDC began in 2015 as JM Global Holding Company, a special purpose acquisition company, a SPAC. In other words, it started life as a publicly traded empty container looking for something to place inside it. Over the following decade, that container would hold environmental technology, waste processing, blockchain, Internet of Things concepts, electronic tokens, artificial intelligence avatars, TikTok commerce, live stream games, interactive novels, and eventually 7,500 Bitcoin. That is less of a business history and more of a witness protection program for corporate identities. In 2018, JM Global completed a business combination involving China Sunlong Environmental Technology and became TMSR Holding Company. The business focused on environmental technology and waste processing operations in China. Then came operational problems and the disruption surrounding COVID-19. The Wuhan area waste business produced no revenue and generated operating losses. In June 2020, the company disposed of China Sunlong and its related subsidiaries. But the public shell survived. The company changed its name to Code Chain New Continent Limited and pivoted toward blockchain, QR code systems, Internet of Things technology, and electronic tokens. Apparently, when the waste processing business stopped working, someone decided the obvious solution was blockchain. By 2023, Code Chain New Continent changed its name again. This time, it became GD Culture Group. The new focus included artificial intelligence-generated digital humans, virtual content production, live stream e-commerce, and interactive games. Through its American subsidiary, AI Catalysis, the company promoted AI avatars, automated content, TikTok marketing, and consumer product live streaming. Products reportedly included Asian snacks, appliances, electronics, and gardening tools. Because nothing says coherent corporate strategy like moving from industrial waste processing to an AI avatar selling snacks on TikTok. By 2025 and 2026, the company was shifting again, this time toward an interactive fiction application called Fado. The company announced that Fado was available through Apple's App Store. It described the product as offering branching stories, visual novel presentation, and chat-style interaction with fictional characters. What does not appear in the filings is meaningful evidence of commercial traction. GDC has not provided investors with persuasive operating metrics such as monthly active users, paying subscribers, retention, average revenue per user, or material product revenue. The company's filings warned that its core operations had generated little or no meaningful revenue. So let us establish the first finding. GDC is not currently supported by a proven operating business. The AI avatars are not demonstrated to be paying the bills. The TikTok storefront is not demonstrated to be supporting the valuation. Fado has not yet been demonstrated to be a commercial engine. This case lives or dies with the Bitcoin. Palace Capital Holding Limited was incorporated in the British Virgin Islands on June 30, 2025. GDC's board approved the transaction on September 8th. The share exchange agreement was dated September 10th, and the acquisition closed on September 29th. Palace was not an established operating company. It had no meaningful operating process. Its primary asset was 7,500 Bitcoin. GDC issued approximately 39.2 million shares to acquire it. The audited annual report recorded approximately $841.5 million of combined acquisition value, rounded elsewhere in that filing to approximately $842 million. But a June 2026 prospectus described the same 7,500 Bitcoin as being worth approximately $876.8 million at acquisition. The company's filings do not reconcile the difference. Using the annual report's accounting figures, the value assigned to the issued shares was approximately $225.7 million, while approximately $615.8 million was recorded as a related party capital contribution. Yes, gallery. According to the accounting, related parties contributed more than $600 million of apparent additional value to the public company. No ceremonial ribbon. No dramatic charitable foundation, just several $100 million in economic difference filed under capital contribution. The natural question is not whether accountants can describe the transaction that way. The natural question is why anyone would willingly transfer ownership of a company holding Bitcoin valued at approximately $842 million for stock, recorded at roughly $226 million. That is the kind of generosity that usually comes with either a halo or several pages of economics that public shareholders have not yet seen. The Palace transaction was not an ordinary acquisition from an unrelated seller. GDC's 2025 annual report says two shareholders involved in the transaction collectively owned approximately 12.86% of GDC before the acquisition. But the original transaction filing lists their respective ownership at 4.12% and 7.28%. Those two figures total 11.4%. The company's filings do not explain the difference. Those shareholders also served as directors of Palace and controlled the Palace shares being transferred. GDC therefore classified the deal as a related party transaction. The sellers included several offshore entities with names such as Wealthy Concord Limited, East Valley Technology Limited, Ocean Harbor Technology Limited, and Divine Sky International Limited. Two of those entities matter again later. Wealthy Concord and East Valley each received GDC shares through the Palace transaction. Those same entities would later form the consortium proposing to take GDC private. This does not prove illegal conduct. It does mean the proposed buyers were not strangers discovering an undervalued Bitcoin company from across the street. They were already connected to the transaction that placed the Bitcoin inside GDC. The same parties appear at multiple points in the transaction timeline. GDC stated that its board obtained a third-party fairness opinion for the Palace acquisition. However, the public exhibit package reviewed does not appear to contain a full fairness analysis that investors can independently examine. The public cannot readily review the advisor's valuation methods, assumptions, conflicts, or explanation for why the transaction was fair. The company says an opinion existed, the reasoning remains behind the curtain, and Inspector Wick becomes uncomfortable whenever $600 million disappears behind a curtain. This is where the skeptical investigation must remain factual. There is stronger evidence supporting the Bitcoin than many online critics acknowledge. At December 31st, 2025, GDC reported 7,500 Bitcoin valued at approximately $663 million. The company's auditor identified the digital asset balance as a critical audit matter. According to the audit report, the auditor reviewed the custody agreement, evaluated the third-party custodian, reconciled the company's records with custody ledgers, reconciled the Bitcoin with the public blockchain, and obtained confirmation directly from the custodian. That is meaningful audit evidence. It would be inaccurate to say there is no evidence that the Bitcoin existed. The proper conclusion is narrower. There is meaningful independent evidence that the Bitcoin existed in third-party custody and that GDC had recognized rights to them as of December 31st, 2025. At March 31st, 2026, GDC's unaudited quarterly filing again reported 7,500 long-term Bitcoin. It also reported approximately 1.08 additional Bitcoin held for short-term trading. Together, the digital assets were valued at approximately $500.6 million. So the corpse has a pulse, at least on the filing dates. But the public still does not have several important pieces of evidence. The public filings reviewed do not identify wallet addresses that allow shareholders to monitor the full balance themselves. They do not identify the custodian by name, and they do not give shareholders enough information to independently monitor current balances or evaluate every possible restriction. That does not mean the coins are pledged, lent, or restricted. It means public shareholders lack enough information to independently rule out every possibility, and the audit evidence was date-specific. It does not tell investors whether the balance sheet remained unchanged 3 months later. At March 31st, 2026, GDC reported approximately $500 million in digital assets. It also reported only $16,805 in operating bank accounts. The company had a working capital deficit of approximately $1.7 million. The company also disclosed that from January 2026 through the date the quarterly financial statements were available to be issued, its chief executive had advanced approximately $310,000 to support operations. That is a bizarre balance sheet arrangement. Imagine owning a private jet but borrowing $20 from your neighbor to fill the lawnmower. GDC's operating business was consuming cash. During 2025, the company used approximately $6.8 million in operating cash. Its chief businesses had not generated meaningful revenue, so GDC needed liquidity. That part is understandable. What happened next is where the body starts leaking embalming fluid. GDC's board authorized a share repurchase program of up to $100 million. The program was scheduled to expire on August 17, 2026. The company later announced that the board had authorized management to sell, exchange, or otherwise dispose of some or all of its Bitcoin to fund the repurchase program and related expenses. The bullish theory was simple: sell a small portion of the Bitcoin. Use the proceeds to repurchase GDC shares trading at a massive discount to reported net assets. Reduce the share count, increase Bitcoin value per remaining share. On paper, that would have been one of the most accretive buybacks imaginable. But an authorization is not a purchase. The company was never obligated to spend the full amount. It could modify, suspend, or terminate the program. And through the filings reviewed as of July 31st, I found no disclosure quantifying completed repurchases. That does not prove no repurchases occurred. It means no completed amount was publicly established in the filings reviewed. Instead of demonstrating that the share count had been reduced, GDC dramatically expanded it, aggressively, violently, with the enthusiasm of a mortician being paid by the casket. On March 31, 2026, GDC reported approximately 60.8 million shares outstanding. After that date, the company sold approximately 720.6 million additional pre-split shares through an at-the-market offering program. Those sales generated approximately $42 million in net proceeds. Let that settle. The ATM alone expanded the outstanding share count from approximately 60.8 million to more than 781 million, nearly 13 times the March 31st total. Then, on June 24th, GDC sold another 259.3 million shares at just 2.1 cents per pre-split share. That transaction produced approximately $5.45 million in gross proceeds and roughly $4.93 million after expenses. After both rounds, the outstanding share count reached approximately 1.04 billion shares, more than 17 times the March 31st count. In less time than some investors spend waiting for customer support. The company raised approximately $47 million overall. That is not the same as raising only $5 million. The ATM issuance was the larger event, and once the full financing sequence is counted, the dilution was even more severe than the final registered offering alone suggested. Before the final June offering, GDC calculated net tangible book value of approximately 69 cents per pre-split share. After the offering, it estimated approximately 52 cents per share. New investors purchased shares for 2.1 cents. That offering price was roughly 4% of the company's estimated post-offering tangible book value per share. That book value was largely supported by volatile Bitcoin holdings rather than freely distributable cash. But the pricing discount was still extraordinary. The offering document calculated that existing shareholders suffered an immediate decrease of approximately 17 cents in net tangible book value per share. The company had publicly discussed selling Bitcoin to fund a buyback. Instead, it sold hundreds of millions of shares at enormous discounts to reported book value. Why? The filings do not explain why management preferred deeply discounted equity issuance over selling a comparatively small amount of Bitcoin. The acquisition agreement represented that Palace held good title to the Bitcoin, free and clear of encumbrances at closing. The March quarterly filing reported no digital asset disposal during the quarter and did not disclose a specific significant restriction. Those statements are date-specific, and current conditions still require confirmation. Until management provides a complete explanation, the financing decision deserves maximum skepticism. A company can possess valuable assets and still destroy value through capital allocation. Owning the gold does not help the passengers if the captain trades the lifeboats for coupons. After swelling the share count to approximately 1.04 billion, GDC implemented a 1-for-250 reverse split. Approximately 250 old shares became one new share. Using the company's last disclosed pre-split count, the reverse split implied approximately 4.16 million basic shares plus fractional share roundups. That estimate does not include excluded warrant shares or any stock issued afterward, so it is not a confirmed current, fully diluted count. The reverse split allowed GDC to regain compliance with Nasdaq's $1 minimum bid requirement. GDC later disclosed that Nasdaq had notified the company it regained compliance and that the minimum bid deficiency matter was closed. That is a verified positive in the narrow regulatory sense. The listing deficiency was closed. But a reverse split does not undo economic dilution. It changes the number printed on the certificate. It does not resurrect the ownership percentage buried beneath it. If someone cuts a pizza into 1,000 slices and then stacks every 250 slices together, you do not have more pizza. You have complicated dinner. On May 1, 2026, Wealthy Concord and East Valley proposed acquiring the shares they did not already own for $10.75 per share in cash. The proposal cited approximately 60.8 million shares outstanding as of April 10, 2026. Because GDC's at-the-market program began on April 28th, that was not necessarily the exact share count when the proposal was delivered on May 1st. The proposal represented a large premium to the prevailing market price. Headlines called it a going private proposal. Retail traders called it a guaranteed payout. Inspector Wick calls it what the document called it: preliminary, non-binding, subject to due diligence, subject to financing, subject to market conditions, subject to changes in capitalization, and specifically subject to the company's ATM issuance. The consortium could revise or withdraw the proposal at any time. It did not provide committed financing. The proposal contemplated possible funding through consortium equity, third-party investment, debt financing, GDC's unrestricted cash, and, subject to special committee approval, GDC's own digital asset reserves. That last item deserves attention. If GDC's own Bitcoin were used to help fund the acquisition, then assets already belonging to the company could participate in financing the transaction that removes public shareholders. That does not automatically make the proposal improper, but it means the headline premium cannot be analyzed without the financing structure. As of the filings reviewed, I found no definitive merger agreement, no Schedule 13E-3, no merger proxy, no binding equity commitment, no binding debt commitment, no shareholder vote, no completed transaction, and no updated offer explaining how the massive dilution and reverse split affected the economics. The original $10.75 figure should not be mechanically multiplied by 250. There is no factual basis for treating the proposal as $2,687.50 per current share. That number belongs in the fantasy drawer between forced short covering and the ghost of EBITDA. The proposed buyers, Wealthy Concord and East Valley, were already involved in the Palace transaction. Each received GDC shares when the Bitcoin holding entity was acquired. They later formed the consortium seeking to take GDC private. This creates an unusual circular structure. GDC acquired Palace through a disclosed related party transaction, and management recorded the excess value of Palace's digital assets over the issued stock as a related party capital contribution. Those two Palace sellers received GDC stock. Those entities later proposed acquiring the remaining public shares. Meanwhile, GDC dramatically increased the share count through its ATM and registered offering. None of that proves a coordinated scheme. But it destroys the idea that the proposed buyers are independent outsiders making a simple third-party acquisition offer. They are part of the story from the beginning. When the donor, buyer, and beneficiary all appear in the same family photograph, Inspector Wick starts checking the inheritance documents. HRT Financial participated in the June financing. The official filing shows HRT purchasing approximately 6.1 million pre-split shares at 2.1 cents. It then reported selling millions of shares shortly afterward at prices of approximately 1.4 cents and 1.1 cents. The rapid sales are more consistent with an active trading position than proof of a long-term fundamental investment. However, HRT's actual intent was not disclosed. There is also an apparent 150,000 share arithmetic inconsistency within the Form 4's running ownership totals. That could be a clerical error or an omitted transaction. It is not proof of a conspiracy. It is simply another item that should not be ignored because it makes the spreadsheet untidy. In this morgue, even clerical errors receive a toe tag. GDC received an unqualified audit opinion for 2025. That provides meaningful assurance that the financial statements were fairly presented under the applicable auditing standard. But it is not a divine certificate of corporate purity. The auditor was not engaged to audit the effectiveness of GDC's internal control over financial reporting. Management separately concluded that its controls were ineffective. Material weaknesses included insufficient USG AAP expertise, accounting staff primarily experienced with Chinese accounting requirements, and inadequate formal accounting and control training. A material weakness means there is a reasonable possibility that a material misstatement may not be prevented or detected promptly. This does not negate the auditor's Bitcoin procedures. It does mean investors should be cautious when interpreting complicated related party transactions, equity issuances, and digital asset accounting. The Bitcoin evidence may be stronger than the surrounding corporate machinery. A healthy heart inside a badly maintained ambulance is still a transportation problem. During this investigation, GDC's primary corporate website redirected visitors to a hosting account suspension page. Some investor relations pages and subsidiary materials remained available elsewhere. A suspended website does not prove insolvency. It does not prove fraud. Sometimes someone simply forgets to pay the hosting company. But when a NASDAQ-listed business reports hundreds of millions of dollars in Bitcoin and cannot maintain its primary website, investors are allowed to raise an eyebrow. Preferably both. Corporate credibility is built from small operational signals, and "account suspended" is not usually printed on the cover of a successful investor relations handbook. Among the retail posts reviewed, sentiment surrounding GDC was sharply divided. The bullish camp focused on the apparent discount between reported Bitcoin value and the market capitalization implied by the company's last disclosed share count. They saw a small post-split share count, a potential buyout, possible repurchases, and a chance that any proof of asset monetization could trigger a dramatic repricing. The bearish camp focused on dilution, related party transactions, limited wallet transparency, weak operations, and the absence of a binding takeover. Both sides raised reasonable questions. Both sides also repeated unsupported claims. Among the bullish theories reviewed were claims that the $10.75 offer was guaranteed, that it automatically became worth thousands per share after the reverse split, or that all dilution was secretly designed to complete the buyout. None of those claims is proven. Other posts suggested the reverse split or QSIP change would automatically force all short sellers to cover. That is also generally misleading. Legitimate positions are ordinarily adjusted. A reverse split is not an exorcism. On the bearish side, claims that the Bitcoin have no supporting evidence are also overstated. The year-end audit procedures provide real evidence. The correct skeptical position is not to automatically believe management. It is also not to automatically reject audited facts because they interfere with the preferred narrative. Facts do not become bullish or bearish until someone starts arranging them. The strongest bull case is simple. GDC's auditor performed meaningful procedures supporting the existence of GDC's rights to 7,500 Bitcoin at December 31, 2025. The company reported the same long-term Bitcoin count again at March 31, 2026. Reported liabilities were small relative to the digital assets. If the company still holds the Bitcoin, if those coins are unrestricted, if the share count has not expanded again, and if management monetizes the assets for the benefit of public shareholders, then the current valuation could represent one of the most extreme discounts to reported assets in the market. A verified wallet disclosure, named Custodian, Substantial Bitcoin Sale, completed repurchase, special distribution, or binding takeover agreement could change market perception rapidly. The upside does not require Fato to become the next Netflix. It requires the company to prove that the treasure chest can be opened by the common shareholder. The bear case is that the discount exists for a reason. GDC has repeatedly changed its operating identity. Its current business generates little meaningful revenue. The Bitcoin entered through a highly unusual related party transaction. The public cannot independently monitor the full balance. Management authorized a buyback and then issued approximately 980 million pre-split shares after March 31st. The buyout proposal is non-binding and involves parties already connected to the Bitcoin acquisition. The company has demonstrated a willingness to issue stock at enormous discounts to reported book value. Its internal controls are weak. Its website was suspended when checked, and the market has no guarantee that Bitcoin value will ever be distributed, repurchased, or otherwise captured by minority shareholders. The most dangerous assumption is that accounting value automatically becomes shareholder value. It does not. Assets can be diluted. They can be spent. They can be pledged. They can be transferred. They can finance transactions designed by controlling parties. And they can remain locked inside a corporate structure while shareholders slowly decompose outside it. The next quarterly filing is the critical evidence drop. Investors need to see the exact Bitcoin balance at June 30th. They need the cash balance after approximately $47 million of equity financing. They need the updated post-split share count. They need to know whether additional shares were issued after the reverse split. They need to see how the ATM proceeds were used. They need to know whether any Bitcoin were sold. They need disclosure of any completed repurchases. They need updated related party balances. And they need any subsequent events involving the proposed going private transaction. If the filing confirms 7,500 Bitcoin, a substantial cash balance from the equity financing, limited additional dilution, and no unexpected liabilities, the valuation discrepancy becomes even more difficult to ignore. If the Bitcoin balance declines without a matching increase in cash or a clear explanation, the central thesis weakens immediately. If the share count increases again, every previous net asset value calculation belongs back on the examination table. GDC is not a simple fraud story. There is meaningful audit evidence supporting the existence of the 7,500 Bitcoin at year-end. Calling the Bitcoin entirely fabricated is not supported by the available evidence. But GDC is also not a simple, undervalued Bitcoin treasury. The company's history of strategic pivots, related party structure, weak operating business, internal control problems, extraordinary dilution, and non-binding buyout proposal make ordinary net asset value analysis dangerously incomplete. The key issue is no longer whether the Bitcoin once existed. The key issue is who ultimately receives their economic value. The common shareholder, the related parties, new investors buying deeply discounted shares, a private acquisition consortium, or broad corporate spending that never closes the discount. I found no public evidence in the filings reviewed that company funds were misappropriated. The concern is that the disclosed use of proceeds was broad and shareholder value realization remains unproven. The enormous discount is consistent with investors distrusting the bridge between reported assets and shareholder realization. That distrust is not irrational. Management must repair it with evidence, not another press release, not another authorization, not another strategic initiative involving artificial intelligence, interactive stories, or a celebrity token. Evidence, current wallet verification, custodian transparency, a reconciled share count, documented repurchases, a binding transaction, and a clear explanation for why a company reporting hundreds of millions in Bitcoin chose to issue approximately 980 million pre-split shares after March 31st. Until then, GDC remains a highly unusual asset vehicle with a potentially enormous balance sheet discrepancy and equally enormous governance risk. The treasure may be real, the map may be accurate, but the shareholder is standing outside the vault while management keeps changing the locks. Bitcoin existence at year-end, supported. Current Bitcoin balance, pending. Buyback execution, unproven. Going private transaction, non-binding. Current share count, awaiting confirmation. Shareholder value realization, cause of death undetermined. This is Inspector Wick. And in the market, the difference between buried treasure and a burial is usually who controls the shovel. Wick's Market Mortuary. Serving body bag holders since 2026. Investigate before you invest.